It's great to be with you guys as always. In today's master series, we'll be discussing indices. The master class is going to be focused on indices. Of course, as always, I'll be taking everyone with me on this journey, whether you are a beginner, whether you're an intermediate trader with the skills of an intermediate level, or whether you are at an advanced level. So we'll be looking at all these particular aspects, but the more important thing really is what we're going to do in this particular webinar today is that we're going to look at the markets, and we're going to try to make a sense of these markets, because since we last spoke, markets have been in a major turmoil. And if you are following us on our social media channels, you would see that we are constantly talking about what exactly is happening within that area and where are the opportunities. But today we'll be trying to figure out, and we'll be trying to we will highlight some specific opportunities which you may want to take advantage, because the biggest question for traders and investors really is, given the massive sell-off that we have seen, if the bottom is in place for the equity markets, and especially for the US markets, because like indices like Dow Jones Industrial Average, S&P 500 index, the Nasdaq especially is down more than 13 to 15% from its all-time high. Is this a good time to buy, or is this just a dead cat bounce that we are seeing in the market? And what are the factors really which really sort of triggered that sell-off? And if traders have started to look beyond that particular sentiment, and if this new optimism in the market is going to be staying here for a longer period of time, or whether this is nothing but just a dead cat bounce in the market. That is all what we'll be discussing in this particular webinar. As always, excuse a little bit of a background noise that you may hear in today's segment because of some construction work which is taking place on site, but the noise is going to be at a very minimal level. Now, as always, before we begin, it is important for me to go through this slide of risk warnings and disclaimers. If you have any questions in relation to this, please feel free to contact your account managers directly. We'll be in a better position to answer your questions. Now, something for a bit of a housekeeping for us, and that is the contact details. They are also right in front of you there. Now, one important thing that I kind of wanted to discuss with you guys is AvaTrade's unique technology. This is quite an important one, and this is a proprietary technology that we have at AvaTrade, which is called AvaProtect. This is a revolutionary one-click risk management tool available on the AvaTrade web trader and of course on the AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends, you will have an open position that is losing. AvaTrade will reimburse the loss directly into the trading account. The only cost, of course, is going to be the AvaProtect fee itself. Now, let's set out the study questions and agenda for today. So the agenda for that is obviously going to be very similar to what we have covered previously, and this is where I would like to go a little bit more faster today, because there are a number of recordings for us covering these same study questions. We wanted to focus on actual aspect of the trading today, and that is that where are the opportunities, and more importantly, I wanted to answer that question: if the bottom is really in place, how to spot that, how to figure it out, how to be more confident. That is something that we kind of really wanted to drill down into in much more detail today, and how you guys going to help me, especially for the people who have already attended our previous webinars, so they will know the answer to most of these study questions. And for the newbies who are joining us for the first time, I will welcome the opportunity for you guys to really participate in this particular similar session as well. Remember, there is nothing like which is classified as a wrong answer or a right answer. Everything is pretty much good to ask. That is why I am here. This is your opportunity to ask us questions. Now, why to trade indices? The first question is the most important one. Why one wants to trade indices? Can anyone answer that particular question? The first one right over here, that which is like, why do you want to trade indices to begin with? There you go. Some of the answers are coming in, and they're saying that this provides a good hedge. What does that mean? Basically, when you trade an index like the US 500, which is a US stock index, you are trading a basket of 500 stocks. So this gives you an wide exposure of all the top 500 companies in the United States. So rather than having one particular company and have an exposure to one company and being exposed to that, where you could potentially be exposed to a massive risk, just like how what happened with Netflix. Let's say if you had a Netflix and only one company in your account, when the Netflix stock is down more than 30% year to date, and it is getting hammered, absolutely. But today, obviously, that is going to change a little bit. But when you have S&P 500 index, you have a much bigger exposure, and hence you are hedging your risk against those basket of 500 currencies really over there, and then that is the important part. Now, Amutha has mentioned it is also quite important from the perspective of momentum, because your indices have more momentum. Now, I think what Amutha really kind of wants to say over here is that indices, the US indices, or any other index of that particular matter, they can move up and down much more significantly on a daily basis. So from a day trading perspective, you have a bit more volatility, you have a bit more room for these indices to move towards that support and resistance zones. What are the support and the resistance zone? Support zone is basically your buy area, and resistance is your sell area. Again, this will make a lot more sense in a bit when we will go over the chart and we'll be discussing about support and resistance zone. For now, the two reasons that you wanted to deal with indices is because if you are a day trader, this is a great instrument for you to trade. If you wanted to have a much wider exposure and less risk, indices are they certainly provide that particular element, that particular factor, so which you wanted to consider. Now, what is the inverse of indices? That is your volatility index. So basically, when equities move higher, VIX, which is the volatility index on the other side, this moves in the opposite direction. So when equities goes up, volatility index goes down, and when equities goes up, volatility as it goes down, volatility index go up. So they have a negative correlation. That is what we call the inverse of indices. This is called your volatility index. It has seen a massive momentum over the last few days. We've seen very, very decent momentum coming in this particular index, with the volatility index, the VIX index, because traders been not too confident. They haven't been. They weren't very confident that where the market is really going to be going. So the volatility was increasing. They were buying volatility. They were selling equities. So again, that is all going to make a lot more sense when we will go to the chart and we will discuss all of that in great detail. Now, so far, are you guys clear about these particular aspects, which is why one wants to trade indices? Okay, so we have two reasons again, because if you want to have a hedge against a basket of other stocks, give me 1 second. Apologies, guys. Had a call with the Wall Street Journal about our view of the market. So apologies. So let's get back to it. Anyway, so we were discussing the two study questions of why to trade indices and when to trade indices, because if you wanted to get an exposure of gains, like for if you wanted to have exposure for across 500 different stocks or 30 different stocks or 100 different stocks, because tech, Nasdaq 100 is an exposure for across 100 different stocks. S&P 500 gives you an exposure across 500 stocks, and then you have your Dow Jones 30, which gives you exposure across the top 30 stocks in the US. So you get a very big exposure, and then secondly, because of the volatility for day trading, they do serve a really good purpose of that, provide you a little bit more volatility and hedge at the same time as well. The second question that we've just gone through is the inverse of indices. The inverse of indices, obviously, this is where we are talking about the volatility index, and we've talked about the correlation, meaning when the stock indices are going up, meaning S&P 500 index goes up, the volatility index, i.e. your VIX, moves lower and vice versa. Now, what is fund flow? That's a question of where do we see the money flowing more? Is it money coming more in the tech sector? Is it going into the overall market? How the market is really performing? Again, we'll be discussing everything by looking at the charts very shortly. Now, let's move over to the charts and then let's discuss everything in a live market by looking at the markets. I hope that everything that we've discussed so far made sense to you guys, and if you have any questions, you can ask them as we go along. Now, before we go into the indices and something else, something that I wanted to cover also is the big rebound sort of taking place in BTC, in the Bitcoin market. We have bounced off from this particular level of 33,000. Now we are moving higher. Something that you wanted to keep an eye on is on the 4-hour time frame, which is where the price is checking or testing is 50-day simple moving average. If it can stay above the 50-day simple moving average, that would be our first signal that the price has changed its direction. And also at the same time, we want the prices to continue to stay above the 50-day simple moving average on the 30-minute and especially on the hourly time frame. Over here on the hourly time frame, the price is against the 200-day simple moving average. We have a bullish signal here where the 50-day simple moving average has crossed above the 100-day simple moving average, and now we wanted to see the price, the 50-day crossing above all these three moving averages, and the 100 crossing above the 200, and that will give us clear indication that Bitcoin has found the bottom and it is going to go to the upside. Just very quickly, I kind of wanted to go through that particular element. It's not part of our discussion today. Our part of discussion today is the markets and indices. Now, this is the Dow Jones Industrial Average right in front of you, and what this tells you right now, looking at the price action, is that what exactly is going on. So let me define a few criteria first before we go into more detail. So what we have is we have 3 different moving averages. This is your 200-day simple moving average. This is your 50-day simple moving average. This is your 100-day simple moving average. What is a simple moving average? A simple moving average is nothing but just a pure average of that derivative under the current circumstances, the Dow Jones Industrial Average for the last number of days, because green line over here represents 200 days. So this is your 200-day SMA. This one over here represents your last 100 days. So this is the average price for the Dow Jones Industrial Average for the last 100 days, and the same goes over here. Sorry, over here for the pink line, this is your average price for the last 50 days. Okay, so these are what these tell us, these moving averages, is when the price begins to break below these moving averages like it did over here, this kind of gives us the first confirmation that the bulls are losing control of the price, and we may see more weakness. And this is what happened. The price actually did lose. The price continued its momentum to the downside, came to us is 200-day 100-day simple moving average. It broke below that. That was a further confirmation that look, bulls are really in trouble, and the final confirmation really came in around this particular price level when the price kind of crossed below the 200-day simple moving average as well. And then from there onwards, the price was very much in a free fall. And day before yesterday over here, the price formed a bottom, an important price level where the price sort of formed, a bottom. Now, we need to define a little bit about the support and the resistance zone, something that I discussed earlier when we were discussing about. So support and resistance level, this over here, the green area, sorry, right over here, is your support area. The last time the price was here, when the price was falling down, I was looking at this particular area, and this was the area which confirmed to us that the rally kind of started. You can see that the prices started to move higher from here, and then we had a high, we had a higher high, another higher high, and then finally the top formed, and the prices took or tumbled from there onwards. Now we did have a violation of the 250 and 100-day simple moving average over here as well. Just as you can see over here, the price did cross, and then we had another violation of the same right over here as well. So this time we knew that the price was continuing to test these particular moving averages, because yes, on the one hand they do tell us that the prices are oversold or overbought, but at the same time, when the price comes near its 200-day simple moving average, it is also considered as a good area to buy. And especially when we combine this one with the RSI over here, which anything near 30 is oversold, anything near 70 is overbought, it gives us a very good indication that the prices are likely to bounce. But under the current circumstances, they didn't. They continue to follow their momentum to the downside, and we formed another lower low in terms of the RSI. And when this happens, when the price goes into such a deep territory like it did over here when the price was over here, this is a very, very strong signal to buy. And then this is what happened since for the last 2 days, because RSI was showing that prices are way, way oversold. It's a really good time to buy. And yesterday and today we are seeing that momentum changing its direction to the upside. So what I wanted to say over here was that the price was testing the 200-day simple moving average over here. We were getting those signals, but after that we did see the rally, but then the price started to violate these moving averages. So over here we had the first warning sign that this upward momentum is this upward trend is losing its momentum. Then again we had another warning that if we see a violation of the 200-day simple moving average, this time we are going down, and we're going down seriously. And when the price come into this area of support over here, because that should be the area that we all should have been focusing on, it was clear that the price is not going to stop. It is going to the next important area of support, or the buy area, where the price came over here. And when the price did come over here, we did see a massive, massive strong bounce. Now, the question for investors and traders is should you buy or should you sell right at this particular level? Is this bounce is a real bounce? Are we going to see a price moving to the upside, meaning challenging the all-time high, and from there onwards moving further from there? Or is the price on the other side, what it is going to do is it is going to move slightly bit higher, and then when it comes near its 200-day simple moving average, or in around this particular area, it will struggle to continue to move to the upside, and what we'll have is a lower high. So you have a higher high, and then we will form a lower high, and from there onwards the price is going to move to the downside. So that is the question which traders want to know. This is their biggest dilemma that they wanted to know. So for us, the way to find that out is that, look, this is a good area of risk to reward, because what you wanted to do really is, if you are looking at it, you may want to put your stop loss just below the low of today's low, and let this price run. Soon, well, if the price comes back into this one, you would be out. But at the same time, there is a possibility that the price may form a double bottom. The double bottom will form that the price may actually goes back up, just like I'm indicating over here. It hits its resistance and then reverses back, and then the first bottom over here, the second bottom over here, and then rather than moving to the downside, the price again moves to the upside. This is a retracement. This retracement is likely. So you may be taken out if you take your trade today, but that would be okay because these sort of stop losses that you're gonna be triggered, they're part of your loss. That is part of your business. So that's okay. You are only willing to lose this much. But if it continues its momentum to the upside, you are targeting at least this area as your first target area, and then this one over here as your second target area. Now, let's say if this trade over here fails and the price comes back to the downside, then you'll be waiting for the double bottom to form again. And as long as the price respects this particular level, you will try to get back in here and then again target to the upside. Alternatively, what two other things can also happen is that the price kind of breaks down below this particular one and then still finds a still find buyers in around this particular area and then goes back up, begins to go back up. Then what you could do is that when the price begins to move back higher and it forms and it starts to make a higher high than the previous day's highs, then you can find the low of that particular one. So for example, it goes back up like this, and then it comes down over here, it comes down over here, it comes down over here, and then it moves back to the upside. So what you do is that you get back into the trade right around this particular price level. When it takes the highs of the previous day, you put your stop loss below the low of this particular candle right over here, and then you move to the upside. You take this particular trade. Now the concept for this particular index can be applied very easily across all other indices as well. Now, when we look at the Nasdaq over here, where is our supply zone? Where is our major support zone? So we look at it on this particular side, and then we formed another one. So we look at this area of consolidation right over here. We see that the price actually did come into this area of consolidation, as you can see over here, and then the price started to move to the upside, as you can see from here. Now of the Nasdaq is also oversold. We have not seen level of like this in the RSI going back all the way to 2021. So Nasdaq is certainly oversold. But at the same time, this particular 50-day simple moving average is quite far from the price, and it seems like that it still has a little bit more room to go to the downside, because what we want to see is we wanted to see a trend like this, meaning the 50 is staying above the 100 and 100 over here is staying above the 200. But it seems like that this trend is about to reverse, because we may see a little bit of a reversal, but then the price may change its direction again. So what we wanted to see is, again, like 50 staying above the 100, 100 staying above the 200. But this seems like that for the Nasdaq, things could be just in a little bit of trouble, because yes, we will see a little bit of a bounce back up, but this bounce back is not as strong as the other S&P 500 index, because under the S&P 500 index, what was happening, sorry, for the Dow Jones Industrial Average, was that it seems like that this trend is still going to continue, because the price, these averages have started to move sideways, so we could see a momentum to the upside. And then plus this over here price action is a lot more bullish in comparison to Nasdaq. Yes, we've seen like the massive momentum, but we haven't gone above the high of the last 2 days. We have gone above the highs of the last 2 days without any problem. But the Nasdaq, it shows that the tech sector is still not that picking up that much of pace as compared to the overall broader market. So we do have a weakness over here, possibilities of price coming over here, or even going towards this particular support zone right over here, which could be a better area to get in. So if you are getting in, you would place your stop loss below the low of this candle, keep your stop losses tight, and you would target this as your first area of profit taking. So your risk would be only this much, and then your reward is going to be this much. So you have literally about 1.5 to 1.75 risk to reward ratio. So you still is okay from that perspective. Your second to take profit here is going to be over here. So you will take half of your position off here, and the other half maybe or the another 1/4 over here. So maybe 1/4 over here, 1/4 over here. Let the other half run, and then see where that will take you. But overall, when we look at the Nasdaq compared to the S&P 500 index, one thing becomes clear, that this is not a very strong index. Now, when we look at the S&P 500 index, and which tells us the overall market, what this tells us that yes, this is very similar to sort of the S&P to the Nasdaq's price action, because the price is struggling to move above the highs of 2 days ago. Yes, it is about to challenge, and in terms of the price action, where the price has really taken us is this area of support right over here. It is this area of consolidation. Sorry, not this one. Let me delete that one. Is this area of consolidation, this area of support that we are kind of looking at, and the price has come into this area. Actually, what is better area really in terms of the price action really is this area, because this had a much stronger bull run from here in comparison to this one. This one was very low because the price only went slightly above the previous high. Over here, the high is here, the new high is here, so this is a better area of support. So I look at it, this tells us that yes, the prices are moving higher, but overall S&P 500 index, it tells us that again the 50-day simple moving average may not fall below the 100-day simple moving average, and 100 stays above the 200. If that is the case, then we could see some really decent returns. So where is the opportunity? What you can do, place a stop loss below the lows of today, let this trade run. And in terms of your first take profit area is going to be right around over here, and then your second take profit area is going to be the all-time high. You will target that. If it moves lower, let it come back over here, wait for the double bottom to form over here, or anywhere retracement over here in this area, all of that area, see it. If not, wait for the price to come maybe over here, and whatever that low is going to be. So if it comes like that, comes like that, comes like that, comes like that, boom, it begins to move higher. You take the lows of those ones and then let this go, but only near the important support levels, because after this, the important support level for the S&P 500 index really is right around these particular price levels over here. So that is the next important area of support. All right, that's all what we got time for today. I hope this was useful to you guys. You can watch the recording of this one once again on our YouTube channel. And if you have any questions, feel free to touch base with me on my Twitter. A lot of you are already following us over there, and I'll be more than happy to answer your question. My Twitter handle is Naeem Aslam23. That's all for now, and remember to follow AvaTrade on their social media accounts as well. That's all, and thank you, and have a great day.